Hello friends, good morning.
Good morning, sir.
Good morning, sir. Good
Friends.
morning.
Yeah, good morning. Am I audible properly?
Yes, sir.
Yes, today there is some issue with my network. Okay, maybe there might be some fluctuations. We'll see. Shall we start?
Yes, sir.
Yes. Okay, right. So we'll continue with our discussion. We can quickly finish this, the last part of the GST discussion. Now in the last class, that is yesterday, the short session, we completed the value of supply, rules related, correct, rules 27, 28, 29, 30, 31, 31 A, B, C, and 32. Under 32, we had five discussions. One related to currency, air tickets, then we had margin scheme, that is second-hand goods, correct? Then we also had vouchers, tokens, and last one,
Bank.
insurance, life insurance, correct? Then those were the rules that we learned. Then we went on to ITC section 16, section 17, section 18, 19, 20, and 21. Also rule 86A and 86B. These were the discussions that we had. Then we went also discussed about registration. There wherein we discussed section 22, the threshold limits, 24, the list of compulsory registrations, 23, where registration is not required, three circumstances, and then the procedure, 25, 26. Then we also discussed about cancellation, suspension, rule 10A, correct? Various discussions that we had. Then today's session we'll continue with that. We have tax invoice, credit notes, and debit notes to start with. Here, with regard to tax invoice, the time limits within which the invoice have to be issued, we have already learnt in time of supply chapter. Correct. For goods, for services, separately we have discussed different scenarios. In case of sale on approval basis, in case of continuous supply of services or continuous supply of goods, correct, different scenarios we have already discussed. In case of tax invoice, they have prescribed that certain items should be there, right? The minimum requirements of a tax invoice, of which details of the recipient, right? What are the details of the recipient that we have to mention on the tax invoice depends on whether the recipient is registered or not. If the recipient is registered, then you have to mention name, address, and GSTN. Whereas if the recipient is not registered, then it depends on the value of the invoice. If the value of the invoice is greater than or equal to 50,000, then you'll mention name, address. GSTN is not there, so name and address, as well as name of the state and the state code. Whereas if the value is up to below 50,000, name of the recipient is only compulsory, all other are optional. However, this exemption of below 50,000 is not applicable to OIDAR service provider, supplies happening through e-commerce operator, and online money giving. Meaning, for these three, less than 50,000, greater than or equal to 50,000, bifurcation is not there. They have to mention name and address, state, etc. for every B2C invoice. Yes, so it was always there, OIDAR e-commerce. They have added online money gaming to the same. Next, even with regard to HSN, in relation to HSN, how many digits of HSN that we have to mention depends on the aggregate turnover of the service provider. If aggregate turnover is beyond 5 crore, how many digits?
6.
6 digits.
6 digits. Whereas if it is up to 5 crores,
4 digits.
4 digits, B2C optional. Correct, for B2C supplies optional. Yes. Then important discussion that we have learned was e-invoice. Correct. E-invoicing is not generating invoice in the e-invoice portal. It is generating invoice in our accounting softwares itself, uploading it to the e-invoice portal and getting acknowledgement in the form of IRN, correct, invoice reference number, as well as the digital signature. Yes, applicability of e-invoices for those taxpayers who have their aggregate turnover in any of the preceding financial years from 17-18 exceeding 5 crore. That's the threshold limit. And such taxpayers have to raise invoice for all B2B supplies and exports. Yes, correct.
Exports.
B2B supplies and exports. However, certain taxpayers are exempted. For example, SEZ unit. SEZ developer don't have exemption. SEZ unit only, right? SEZ unit, insurance companies, banking company, financial institution, NBFC, GTA, goods transport agent, then supplier of passenger transportation service and multiplex screens, cinema halls, then government departments, local authorities. For these, exemption is available from applicability of e-invoice, even though their aggregate turnover exceeds 5 crores. So they have what they have to do, they have to give a declaration. Right? They have to give a declaration that no, it's not applicable for us, even though my aggregate turnover exceeds in the invoice. Then for B2C supplies, there is a concept called dynamic QR code. Right? Dynamic QR code applicability is
500 crores.
yes, aggregate turnover exceeding 500 crore in any of the preceding financial years. So what do we understand by dynamic QR code? The QR code should mention the amount payable as well for making the payment, and it should take to the payment gateway, right, to make the payment. It is applicable only for B2C. Correct, all B2C supplies. However, there are exceptions. If payment is already made before issuance of the invoice, part payment is made only to the balance amount, the QR code should mention the amount. So there is exemptions available. And apart from that, the same exceptions, insurance company, banking company, NBFC, GTA, supplier of transportation, multiplex. For these, they need not have the dynamic QR code. Along with them, for export invoices not required and OIDR service provider not required. Okay, these are the concepts which are there in tax invoice. Apart from that, we have few other documents like revised tax invoice. When do we use revised tax invoice? We use revised tax invoice when we get the registration within that, when we have applied for within registration within 30 days of becoming liable, we will get the registration subsequently, but it is effective from the date of I becoming liable for registration. So during that time period, whatever supplies we have made should be a taxable supply, but at the time of supply I was not registered. So for all those transactions, we will have to raise a revised tax invoice. Now, can I raise revised tax invoice on a consolidated basis? Single revised tax invoice. For that, there are circumstances. So, for example, it is applicable. The consolidated revised tax invoice is applicable only for B2C supplies. If it is a intrastate B2C, irrespective of the amounts of the invoice, all intrastate B2C together, one consolidated revised tax invoice can be raised. Whereas for interstate, if the individual invoice value exceeds 2.5 lakh, then compulsorily you have to raise recipient-wise revised tax invoice. However, if the invoice values of such interstate supplies is up to rupees 2.5 lakh, then you can raise consolidated tax invoice. That's about revised tax invoice. The consolidated revised tax invoice. Now, normal regular tax invoice, can I raise one single consolidated tax invoice? There is a circumstance, there is a scenario. Again, 3 conditions have to be satisfied. What are the 3 conditions? One, it should be a B2C supply. Second, the recipient has not insisted for the invoice, tax invoice. Third one, value of such supply is less
Below
than
200.
200. Yes, less than 200 rupees. If these 3 conditions are satisfied, when can I raise revised tax invoice, consolidated tax invoice? Is it monthly once, 15 days, weekly?
At the end of each day.
Daily.
Very good. At the end of each day, right? At the end of each day, we can raise the revised tax invoice. Then we have a concept called the bill of supply. Bill of supply will be raised for other than taxable supplies, that is exempt supplies. In case of composition scheme where we cannot collect tax, correct, in those cases bill of supply will be raised. Then delivery challan. Delivery challan is for movement of goods for other than by way of supply, right? For sending it for job work, for demo, sale on approval basis at the time of removal, right? In all those cases, we have to raise delivery challan. And then we had credit notes and debit notes. When do we raise credit notes and debit notes? Credit notes will be raised either when the value of supply was erroneously declared more, rate of tax was erroneously declared, a higher rate of tax was declared, then quantity received was lesser than what is mentioned in the invoice, quality is not to the satisfaction of the recipient as mentioned. So in all these cases, for reducing the value, you can raise a credit note. Similarly, ulta, in case of debit note, if we have erroneously declared lesser value, we have to increase the value. Erroneously declared lesser tax rate, we have to increase the tax rate. We have received a higher quantity than compared to the invoice. In those cases, debit notes. Debit notes would be issued. Yes. Then now they have de-linked the credit notes and debit notes to the invoices. So it need not be invoice specific. Correct? It should be party specific. Yes, these are some of the discussions that we have in tax invoice, debit notes, and credit notes chapter. Okay, are we following? Any doubts? No, following. Okay, right. Next one, accounts and records and e-way bill. The next chapter. Right, every registered person should maintain accounts and records at principal place of business. If he has any additional place of business there as well, related to that additional place. Then till what time period he has to maintain the books of account, that accounts and records? Period of retention.
8 years. 7
8 years.
years.
6 years.
6 years. It's getting reduced. Okay. So till 72 months, which is 6 years. 72 months from the due date of filing the annual return for that financial year. So financial year 22, 23, 24. Due date would be 31st December 24. From 31st December 24, 72 months, 6 years. That is 31st December 2030. Till that time period, the books of accounts and records have to be maintained. However, if there is any appeals in or revisions in relation to that particular year, then you have to maintain until 1 year after the disposal of appeal, or 72 months from the due date of annual return, whichever is later. Right? If appeal takes more time than that 72 months, etc., then you have to maintain the accounts and records even after that, 1 year after the final appeal is disposed of. Okay, that's about the maintenance of records. Then e-way bill. The next concept, e-way bill. E-way bill is used as a documentation for transportation of goods. Correct. When will the e-way bill be required? When the consignment value exceeds
50,000. 50,000.
Yes, 50,000. Yes. It's applicable for all movements, whether it's a supply, whether it is other than supply. Correct. In all those cases, e-way bill is required. Even if we as a registered person is receiving the goods from unregistered person, we have to do for inward supply the e-way bill. Correct. However, that 50,000 rupees limit will not be applicable for interstate supplies of handicraft goods and interstate job work transfer, right? In those two cases, 50,000 limit is not applicable, meaning without a threshold, the e-way bill requirement have to be complied with. E-way bill has two parts, part A and part B. Part A contains the invoice details and part B the transporter details. Part B will not be required if the amount, the distance being traveled is less than, is up to 50 kilometers. Up to 50 kilometers for shifting the transporter, etc. If the travel is up to 50 kilometers, then part B is not required. Can we cancel the e-way bill?
Yes.
Yes. We can cancel it within 24 hours of its generation. Correct. Then what is the validity of the e-way bill? It depends on the distance being traveled. Normally for every 200 kilometers, 1 day validity. When I say 200 kilometers 1 day, for the first 200 kilometers, the 1 day will be starting from the midnight of the day on which e-way bill is generated. That is, if I generate today, 24th March at 7:19 a.m., I'll for traveling that first 200 kilometers, I'll get time up to midnight of 25th. Correct? Today midnight plus 1 day. So full today plus tomorrow. Right? So that is 1 day. And for every additional 200 kilometers, one additional day will be added. However, for over-dimensional cargo, large vehicles, it would be 20 kilometers instead of 200. Instead of 200, it is 20. Yes. Then in some cases, we have exemptions as well from generation of e-way bill. There is a list, right? We can quickly look into that list. These are the scenarios where goods being transported are LPG for supply to household and non-domestic exempted categories. Then kerosene oil, postal baggage, Department of Post, pearls and precious, semi-precious stones, jewelry. However, for imitation jewelry, they have removed the exemption. So now for imitation jewelry, e-way bill is required. Then currency, used personal and household effects, coral, unworked and worked, right? Where goods are being transported by a non-motorized conveyance. If he is taking it on a bicycle, not required. Where goods are being transported from customs port, airport, cargo, land customs station to an inland container depot or container freight station. In customs, we have this concept, these two concepts, right? ICD and CFS, inland container depot and container freight stations. So when you are transporting the goods from customs to ICD or CFS, e-way bill is not required. In respect of movement of goods within such areas notified, and where the goods being transported are exempt from tax, then not required. However, if it is de-oiled cake, it is required. Where goods being transported are alcoholic liquor for human consumption and petroleum products, not required. Where supply of goods being transported are treated as not a supply under Schedule 3. Where goods are being transported under customs bond from inland container depot or CFS to customs port back. Then where goods being transported are transit cargo from or to Nepal or Bhutan, where goods being transported are exempt from tax, wide exemption notification dated 2017, that is supply of goods by CSD to unit run canteens to the authorized customers, or supply of heavy water and nuclear fuels, atomic energy, any movement of goods caused by defense formation. Consigner of goods is central government, local authority for transport of goods by rail. Empty cargo containers are being transported, where goods being transported up to a distance of 20 kilometers from the business of the consigner to a weighbridge for weighment. Then e-way bill itself is not required. Where empty cylinders of LPG are being moved for reasons other than supplies. Right? These are the cases where e-way bill requirement is not applicable. Clear? Yes. Fine. Then the next discussion that we have, the next chapter, payment of tax. In payment of tax chapter, broadly they are discussing three ledgers. What are the three ledgers? Electronic cash ledger, electronic credit ledger, and electronic liability ledger. From electronic cash ledger, I can pay any tax, interest, penalty, fee. Whereas from electronic credit ledger, I can only pay tax. Yes, I can only pay tax.
Output.
Tax component only, not interest, penalty, etc. Then we have to make the payment electronically through electronic mode. However, over-the-counter payment is also available. However, the limit is, what's the monetary limit for over-the-counter payment?
10,000 per taxpayer.
Very good.
10,000.
10,000 per challan, right? Per payment. Per payment, 10,000. We can also transfer from electronic credit cash ledger from one major head or minor head to another major head or minor head, including to distinct person. From one entity to another entity, distinct persons possible through PMT09. However, that's only for cash ledger, not credit ledger. Correct. Then order of discharge of tax and other dues. If you have money in electronic cash ledger, how will they have to, in what order they have to discharge it? First, they have to pay the self-assessed taxes. First, self-assessed taxes of the previous periods, earlier periods, then self-assessed taxes of the current periods, then other dues, that is demands determined under section 73, 74, etc. That is the order in which it has to be paid. And whenever we make payments delay, then we have to pay interest under section 50. Correct? Interest in relation to output, normally it would be on the cash portion, that is after utilizing the input tax credit, right? Net basis. So at 18% per annum. Whereas if it is related to, the demand is related to proceedings under 73, 74, it will be on gross, the gross liability. Interest will be paid on the gross liability. Similarly, in relation to ITC, if you have availed wrong ITC, yes, interest has to be paid at the time of reversal only when we have utilized that input tax credit. So it is wrong availment and utilization. If we haven't utilized, then we need not reverse it. That's what that particular provision says. As well as there is a recent clarification which said that in relation to IGST reversal, a reversal of ITC or wrongly availed IGST, we have to consider whether interest liability arises or not, depends on the total input tax credit which is there in the credit ledger, including CGST and SGST. IGST, CGST, SGST total has to be considered. Only if the wrong availed ITC, when we are reversing, it falls below the balance which was there at the time of availment in the electronic credit ledger, only then interest liability arises. Correct? Total. However, compensation cess should not be added because compensation cess credit is not available for IGST, CGST, SGST. Yes. So only on wrong availment of wrong utilization of ITC, interest would be liable to be paid. Then the next discussion there was with regard to TDS under section 51, tax deducted at source. Who are for what supplies TDS will be applicable? Supplies made to central government, state government, departments or establishments, local authorities, government agencies, or which are board authority or board which are notified, that is set up by an act of a parliament or established by government, where 50% of the participation is of the government. These are the government entities which are for which TDS registration is required and TDS applicability will be there. When will they have to deduct TDS on all supplies, or there is a monetary limit?
2,50,000 invoice.
Very good.
2,50,000.
Yes, the taxable value of goods or services is more than 2,50,000. For eBay bill, we say consignment value exceeding 50,000. Here it is the taxable value. TDS will be made on the taxable value, correct? So exceeds 2.5 lakh as per the invoice or the contract. Then TDS have to be made at the rate of 2%. If it is intrastate, 1%, 1%, interstate, 2% IGST. However, in one scenario, even if the taxable value exceeds 2.5 lakh, it will not be applicable. Where the location of the supplier and the place of supply is in the same state, which is a different state from the state of registration of the recipient. Right? Of the supplier rather. So for example, this location of the supplier is in Bangalore. Place of supply is also Bangalore. Let's say in relation to a immovable property which is there in Bangalore. But that government department is registered in Mumbai. They have a TDS registration of Mumbai. In that case, what happens? It is CGST, SGST of Karnataka that they will be issuing the tax invoice. But Mumbai registration, they cannot do TDS of CGST, SGST Karnataka. So neither it is an interstate supply to do IGST. So the law says no TDS required. Correct? That exception is there. That can be asked in the exam. Important. Then the next concept, similar to TDS, we have TCS, tax collected at source. Now, in relation to tax collected at source, section 52, for e-commerce transactions, TCS will be applicable for all e-commerce transactions other than transactions covered under 9.5. Because 9.5 e-commerce operator himself will pay tax. Correct? The TCS rate is 1%. That is 0.5, 0.5 for CGST, SGST, 1% IGST on the net value of the supply. So they do it on a monthly basis. In that month, what is the net value of the supplies that happened through that e-commerce operator? Net value means total value of supplies minus returns. On the net value of the supplies, TCS will be made. Right? So what are the supplies which are notified in 9.5? There are 4 plus 1 now. Now, what is this 4 plus 1? First one, services by way of transportation of passengers by motor vehicles, by any motor vehicle. They have mentioned many radio, taxi, maxi cab, etc. by any motor vehicle except omnibus. Why omnibus is excluded from the first point? Because they have included it as the second service. That is services by way of transportation of passengers by omnibus, except where omnibus is a company. The service applying through that e-commerce operator is a company. So for omnibus, 9.5 applies only if the service provider is non-corporate, non-company. Right? This is the recent amendment that they have done 1st of October 2023. Then next one, services by way of accommodation of in the hotels, inns, guest house, etc. Then service by way of housekeeping services. Then supply of restaurant service, except where the restaurant service is provided in a specified premise. What is specified premise? In that particular premise, there should not be an accommodation service where the room charges are more than rupees 7,500 per day. If there is more than 7,500 per day rooms available in that premise, then for restaurant service provided in that premise, 9.5 is not applicable. Having said that, for accommodation service and for housekeeping service, if the service provider threshold exceeds the threshold required for registration, then 9.5 will not be applicable. They themselves have to pay tax. So basically 9.5, when will 9.5 apply for accommodation and housekeeping? Only when service provider is not liable for registration. Only if service provider is not liable for registration. However, this concept will not be applicable for passenger transportation and restaurant. For passenger transportation and restaurant, irrespective of the liability of the supplier for registration, it comes under 9.5. That's the difference between the first and the last service and the third one and the fourth one, housekeeping and accommodation. Are we understanding?
Yes.
Yes, as a TDS person, a person who has to make TDS, they have to file GSTR 7. TCS persons, they have to file GSTR 8. Correct? For transferring the credits, the TDS or TCS that they have deducted. Yes, this is about the e-commerce transactions. TCS and the applicability of 9.5. If 9.5 is applicable, no TCS. If 9.5 is not applicable, TCS. Simple. Then the next chapter that we have is returns. Again, this chapter mainly talks about the procedures and the different types of returns that we have. Right? We have GSTR1 to start with. GSTR1 and IFF, all outward supplies. In some cases, they are debarred from filing GSTR1. And when IFF will be applicable in case of QRMP scheme. Then GSTR 2A and 2B. These are communications that we get in the portal in relation to the invoices furnished by the supplier. Correct, supplier. So GSTR 2A is dynamic, GSTR 2B is static. GSTR 2A is period specific, GSTR 2B is the communication of those invoices which were filed in that period. The invoices can be of earlier periods as well. Correct. That's the difference between 2A and 2B. And the GSTR 3B is the return under section 39, which we have to file and pay the tax. And then QRMP, quarterly return monthly payment scheme, can be asked in the exam. Right? They can ask you the applicability, what are the advantages, right? So QRMP applicability, what is the threshold limit turnover?
5 crore.
Yes, correct. 5 crores in the preceding financial year. Right? The aggregate turnover up to 5 crore in the preceding financial year. Then they can go under QRMP. What happens here? The returns will be filed every quarter. but payment will be made every month. Correct? When you make the payment on a monthly basis, there are two ways in which payments can be made. One, fixed sum method. Second one, self-assessment method. Under fixed sum method, previous quarter total liability into 35% in the first month, 35% in the second month, balance in the third month. If we go with fixed sum method, if there is any shortfall in the payment in the first and the second month, there will be no interest liability because we are going with the fixed sum 35%, 35%. Whereas under self-assessment method, you can pay the tax based on your self-assessment on a monthly basis. Every month, what is your total invoice? What is your input tax credit? Pay tax. At the quarter end, you will consolidate the same. Correct? In that case, if there is any shortfall, interest liability will arise. That's the risk that we'll have in self-assessment. Now, once the returns are filed, this is about QRMP. Once the returns are filed, can I rectify the mistakes? Can I revise the returns?
No, sir.
No, there is no concept of revision. However, can I rectify the errors? Yes, rectification in the form of amendments are available in the returns that can be made up to 30th November of the next financial year or date of filing annual return, whichever is earlier. Same 16 for time limit. Same time limit is applicable for amendments or rectifications as well. As a composition taxpayer, what are the returns that I have to file on a quarterly basis for the purpose of payment of tax? I have to file
CMP 08.
CMP 08, and on an annual basis, before 30th April, I have to file
GSTR 4.
GSTR 4. Correct. Yes. So these are the two returns, and obviously we also have annual returns, which we'll discuss. GSTR 4 is done. What is GSTR 5 return for?
NRT.
Very good. NRTP. 13th of the subsequent month. Right? NRTP. Then GSTR 6 is for
ISD.
ISD. 7 is TDS, which we have discussed. 10th is the date. 8th is TCS. GSTR 8 is TCS. And GSTR 9, 9A, 9B are the annual returns. 9 for regular taxpayers, 9A for composition, 9B
E-commerce.
e-commerce. Perfect. Then GSTR 10 is the final return that we'll have to file after cancellation within 3 months from the date of order or date of communication of the order of cancellation. GSTR 10 has to be filed. Then GSTR 11 is for in refund chapter also we'll discuss the same. GSTR 11 UIN holders. Right? For UIN holders, they'll get the refund of the taxes that they have paid. That refund, how do they claim it? By filing GSTR 11. So that's the returns for UIN holders. And for OIDAR and now online money gaming, we have GSTR 5A. GSTR 5A is for OIDR suppliers and online money gaming. These are the different returns that we have. Right? The next chapter, we'll move on to the next one. Before that, everyone following, understanding?
Yes, sir.
Yes. The next chapter that we have is imports and exports under GST. Now, import of goods, with regard to imports and exports, first imports, when we are discussing, we have two discussions: import of goods, import of service. Import of goods, IGST is levied under customs law. For import of goods, customs law, the exception is the recent amendment which happened. The exception is
Online money.
yes, online money gaming. Online money gaming is an actionable claim which comes under goods. However, since it is intangible, physical goods is not coming in through customs port. Under customs law, it is not possible. So, for that, normal provisions of section 5(1) of IGST Act, the normal charge only will be applicable for online money gaming. That's what the amendment, the proviso to 5(1) has been amended. Yes. Then, for import of services, normally RCM. Correct? Again, the exception would be OIDR service. Then, coming to export. in relation to whether it is export of goods or export of service, we will be going with the concept of zero rated supply. That's called zero rated supply. Yes, we'll discuss about zero rated supply a little later. With regard to OIDAR service, right? When do we consider an import of service as OIDAR? What is OIDAR? Online Information Database Access and Retrieval. So these accessing the database, information database, or retrieving the information database, if it is happening over internet mediated by information technology. So without the interference of information technology, if that supply is not happening, that supply is not possible, then that is called OIDAR service. Right? So two conditions: service whose delivery is mediated by information technology over internet, and services are impossible to ensure in the absence of information technology. If these two tests are satisfied, then it would be OIDAR service. Clear? If it is an OIDAR service, then it would be taxable. How it would be taxable? It depends on to whom such OIDAR services are provided. If it is provided to a registered taxpayer, then it is taxable under
RCM.
RCM. If it is provided to unregistered, then forward charge. Yes, the next concept that we have is zero rated supply, section 16 of IGST Act. Zero rated supplies covers export of goods or service and supplies to SEZ unit or SEZ developer for authorized operations. Export of goods and service, we don't have that condition of authorized operation. For SEZ unit, SEZ units or SEZ developers, we have that condition. Authorized operation, it should be authorized by the officer, SEZ officer. Yes. And for zero rated supplies, for making zero rated supplies, all the input services that I get, can I take input tax credit?
Yes.
Yes, ITC is allowed, even though output tax is zero, right? That's the difference between nil rated and zero rated, right? So nil rated comes under exempt supplies, so ITC is not allowed, whereas zero rated supplies comes under taxable supplies itself. Therefore, ITC will be allowed. Okay, then similar to this zero rated, we have a concept called deemed export, right? Deemed export, merchant exports. These are not zero rated supplies. What is this deemed export? Deemed export is supply. There are notified supplies which will be considered as deemed export, like supplies against advance authorization, again related to customs, FTP, right? Advance authorizations to EOU, EHTP, STPs, etc. Then supplies of capital goods against EPCG scheme, export promotion capital goods scheme. Then supply of goods to EOUs, supply of goods to a bank or public sector undertaking against, again, advance authorization. So all those through advance authorizations or EPCG schemes, they come under deemed export concept. If it is a deemed export, what is the taxability? At the time of supply, it is taxable. You have to collect and pay tax. Subsequently, refund should be claimed. Who can claim the refund? Either the supplier or the recipient. Clear? Right? That's how deemed export works. Whereas in case of merchant export, again, the law doesn't use the word merchant export. What happens in case of merchant exports? The supplies will be made with at the rate of
0.1%.
yes, 0.1% with ITC. Correct. What is this merchant export? Supplies are made to an exporter who will be exporting that goods as it is. Right, that is called merchant export. There are conditions to be satisfied. That exporter has to export within 90 days of the merchant export transaction, and it should be only through LUT only. The exporter cannot go with the option of with payment of tax. It has to be without payment of tax. Correct. Various conditions are mentioned there. So for merchant exporters, merchant export transaction to be taxed at 0.1%. The exporter as well as merchant exporter both will get ITC. Both are eligible to claim the ITC. Yes. Then the next concept is export of service. In relation to export of service, for export of goods and export of service, The common conditions are goods should move out of India, the services, the place of supply should be out of India. That those conditions are there. But in export of service, there is one additional condition. What is that additional condition?
Foreign currency exchange.
Yes. Consideration to be received in freely convertible foreign currency or wherever permitted by RBI in Indian rupees. Correct. That is one additional condition, important condition in case of export of service. That has to be proved that the funds have been received. The consideration is received. That's the condition to be proved. Okay. These are the concepts that we have in imports and exports. In relation, in continuation of the same, we have the next chapter, refund. Right? There are various circumstances that that are available where I can claim refund, where I can get refund, like export, that is zero rated for exports or SEZ supplies with the payment of IGST. For the tax paid, I'll get the refund. In case of refund of unutilized ITC, in two scenarios, I'll get refund of unutilized ITC. One, zero rated supplies without payment of IGST and inverted duty structure. In two cases, I'll get refund of unutilized ITC. Then in case of deemed exports, after the supply is done, I can apply for refund. If we have excess balance in electronic cash ledger, we can apply for refund of the same. Then tax paid wrongly, instead of CGST, SGST, IGST or vice versa. Once after paying the correct tax, I can claim refund of the wrong tax paid. Tax paid even if there is no supply made, that is, tax is paid on advance. Subsequently, that supply didn't happen, you can claim refund of such tax paid. Then refund of IGST paid by tourist living India, only IGST. Refund of IGST paid by tourist living India, and refund on account of court judgments, court orders. Right? These are various cases where refunds can be claimed. However, one important point in case of refunds is unjust enrichment, incidence of the tax, right? Passing on the incidence. You should not have, as a applicant of refund, you should not have transferred the or pass on the incidence of the tax to some other person. Incidence should be on you. So for that, if they go with the declaration, right? If the amount of refund application is up to 2 lakh, declaration, you should just give a declaration stating that incidence is not passed on, right? Anyhow, that what is it? The declaration is made available online in the application itself as a checkbox. Then next one, if the amount, refund amount is more than 2 lakh, then the declaration should also be supported by certificate by a chartered accountant or a cost accountant. Yes. In case of refund in relation to zero rated supplies, okay, as soon as the refund application is filed, within 7 days, they will give you provisional refund. Amount will be credited to the bank account. Provisional refund to the extent of 90%. 90% of the refund application. And anyhow, what is the time limit for processing the refund application? Once the application is filed?
60 days.
Yes, correct. 60 days. 60 days is the time. That will be there. For processing the application, 60 days time limit will be available. Now, what is the time limit within which we have to file for refund?
2 years.
2 years from the relevant date.
Yes, very good. 2 years from the relevant date. The relevant date depends on the circumstances for which refund is being filed. Correct. So 2 years from the relevant date is the time limit available for us for making application for refund. What would be the amount of refund that we are eligible to claim, especially in those two cases, that is unutilized ITC, accumulation of unutilized ITC, zero rated supplies and inverted duty. In relation to zero rate, there is a formula. In relation to zero rated supplies, the formula for calculating the refund amount, eligible refund amount will be equal to turnover of zero rated supply of goods plus turnover of zero rated supply of services divided by adjusted total turnover into net ITC. This is the formula for calculating, right? Calculations can be asked in the exams. Now, for calculation of what is this? Why have they given separate bifurcation? Because turnover of zero rate supply of goods and services calculations are separate, different. The different ways in which it will be calculated. How will we calculate? What is the value of what is the turnover of goods? It would be the invoice value or
FOB value.
FOB value. No,
1.5 times of the
correct. Very good. 1.5 for 1.5 times of value in the domestic market. Correct. Whichever is less. Whereas in case of services, they go with receipt basis. Amount received during the period. Add amount received in the earlier period for which supply is made in the current period. Minus amount received in the current period, but supply will be made in the subsequent period. Carry forward. Supply made in subsequent period. This is the amount of zero rated supply of services. Clear? Now, coming to net ITC, what is included in this? Can we claim input tax credit of capital goods refund?
No.
No, it's only inputs and input services. Inputs and input services. This is the formula for zero rated supply. Are we clear? Yes. Whereas in case of inverted duty, see in the difference between zero rated and inverted duty. In zero rated, we would have not paid tax at all output supply. Whereas for inverted duty, we would have paid tax on output supply. However, at a lesser rate when compared to my input. Correct, that's the difference. That's the concept of inverted duty. My output supply is rate of tax of output supply is lesser than the rate of tax or inputs. So for that concept is called inverted duty. So in that case, the refund will be, to start with, it's the same. This whatever is there here, same concept, bring it here. That is turnover of inverted duty structure supplies, inverted duty supplies divided by adjusted total turnover into net ITC. However, here we would have paid output tax. So that I have to minus tax payable on outward supply of inverted duties. Outward supply in relation to such inverted duty supplies. However, this have to be taken proportionate, multiplied by net ITC divided by ITC on inputs and input services. Inputs and input services. Here, net ITC will be only inputs. That's the difference. In zero rated, it would be inputs and input service, whereas in case of inverted duty, it is only inputs. Only inputs. Are we clear? Yes, these two formulas are very, very important. Then, as we discussed, the time limit available for processing the application is 60 days. If not processed within 60 days and refund is not paid, then for delay, interest have to be paid by the department at 6% per annum. Right? Interest at the rate of 6%. If incidence is not passed on, rather, if incidence is not passed on, refund will be credited. If incidence is passed on, if the department feels that incidence is passed on, in that case, instead of crediting to the bank account, they'll credit it to consumer welfare fund. The refund amount will be credited to consumer welfare fund. See, what is the implication? The implication is even that amount, even the department cannot retain it. They have to compulsorily transfer it to consumer welfare fund. Are we clear? That's the chapter on refund. Then we have a small discussion on job work. Right, two sections. Section 143, which talks about the job work procedure. Section 19, which gives us the claim of input tax credit on such goods sent to job work. Yes, as a principal who is sending goods that is in the form of inputs and capital goods to the job worker, at the time of sending the goods to the job worker, it will not be considered as a supply. Right? It will not be considered as a supply, provided the inputs sent will be returned back within
1 year or 3 years.
1 year, and capital goods sent will be returned within 3 years. Correct? Inputs 1 year, capital goods 3 years. If not returned within the prescribed time limit, then it would be deemed to be a supply when it was sent. Right? It would be deemed to be a supply when it was originally sent. So that's the main concept. There are various procedures. Delivery challan has to be issued in triplicate, correct, at the time of sending it. And the job worker, once his job is done, either he can send it back to the principal, or he can send it to another job worker for further processing, or he can directly send it to the customer's place. Those are the concepts which are there. The procedures mentioned in the section 143 read with rules. And section 19 says they can claim the input tax credit. Principal can claim directly. They need not wait, or they need not reverse for the goods sent to the job worker. And as a supplier, as a principal, you have to intimate the goods that you have sent to the job workers to the department in ITC 04. ITC 04 has to be filed periodically, which they have notified. If your aggregate turnover is up to 5 crore, you have to file ITC 04.
25th April.
Yes, on an annual basis, 25th April. Whereas if the aggregate turnover is beyond 5 crore,
25th October and 25th April.
yes, half yearly basis, 25th October and 25th April. Excellent. That's the concept of job work. Right? Then the next concept, assessment and audit. There are different types of assessment under GST law. The most commonly found is self-assessment. The monthly returns that we do, right? It's on a self-assessment basis. If you are not, as a taxpayer, you are not available to determine the value of the taxable supply or the tax rate which is applicable for that particular supply, then you can go for provisional assessment, meaning you can apply to the officer for provisional assessment. In case of provisional assessment, they'll at the time of assessing, they will ask for a security in the form of bond. The bond will have a security which should not be more than 25% of the bond amount involved. The provisional assessment should be finalized within the assessment should be finalized within 6 months. Upon finalization of the assessment, upon payment of the required tax, that security, the bond, will be released. That's provisional assessment. Then the third one is scrutiny. Scrutiny assessments, scrutiny of the returns. Right? They'll look into the returns that you are filed. If there are any discrepancies, issue the notice. Based on the reply received, action will be taken. If the officer is satisfied, then they will close the scrutiny there itself. If they are not satisfied, further proceedings will be initiated, 73 or 74 as the case may be. Then assessment of non-filer. If you have not filed the returns, they'll send you notice to file the returns. Even after sending the notice, if you have not filed the returns, then they will pass an order. How? Best judgment based on the available records. For example, you have filed GSTR 1, but you have not filed GSTR 3B. In that case, whatever output tax liability you have declared in GSTR 1, that will be considered. Whatever input tax credit is available in 2B, they'll, on a best judgment basis, they'll consider some amount as ineligible, etc. They'll claim, and then they'll pass an order of this is the total amount payable. Right? That is the assessment of non-filers. However, once this order is passed, right? Once the assessment order is passed for non-filer related case, within 60 days of the order being passed, if the taxpayer files the returns, then this order has to be withdrawn. Or if he files the returns beyond 60 days and pays 100 rupees per day as late fee towards this assessment, then also order has to be withdrawn. Clear? Yes. Then similarly, assessment of unregistered person. He is liable to register, but he is not registered. In that case, same best judgment based on the records available, based on his income tax records, whatever records available on a best judgment basis, they can pass the order. What is the time limit to pass an order for unregistered person related? It is 5 years from the due date of filing the annual return. So they can go 5 years. Yes. Then next one is summary assessment. In some cases, for doing the complete assessment and passing the order, it might be difficult, or it might injure the interest of the revenue. Right? The taxpayer might destroy the records. He might transfer all the money so that recovery might not be possible. So to protect the interest of the revenue, summary assessment order will be passed. That is, they'll do the assessment in a very short manner within the short time span, normally in one hearing itself, and they'll pass the order. However, since this is summary assessment, they would have not deliberated into the issue. If the taxpayer requests to withdraw the summary assessment, within 30 days of the order passed, they have to withdraw it. Or they themselves, department themselves, they feel that the order passed is erroneous, summary assessment is not possible for that scenario, then they themselves can withdraw. Okay, these are the different types of assessments: self-assessment, provisional assessment, scrutiny assessment, assessment of non-filers, assessment of unregistered persons, and summary assessment. Clear with this? These are the different types of assessment under GST law. Then we have audits. There are two types of audit: section 65 and section 66. 65 is departmental audit, right? If the tax authorities feel that they have to audit the records of any of the taxpayer, then they'll issue, based on the authorization received, either general authorization or specific authorization, they'll issue ADT 01 notice, correct? So once the audit notice is issued and requiring the documents, once the audit is commenced, it has to be completed within 3 months. Further extension of 6 months is available. The commissioner has to extend it. Yes. Once the audit is completed, you will have audit observations, findings. That audit findings or observations should be intimated before the audit report is issued. Once the audit report is issued, audit is said to be completed. What happens? What is the further action to be taken if there are any discrepancies found in the audit report? Then further proceedings will be initiated under section 73 or 74 based on the audit findings. This is the audit procedure, how it works. Similarly, special audit. Special audit under section 66. Here what happens is, this will be on a specific issue. Right? For example, availability of ITC. The department feels that they have claimed lots of ineligible input tax credit. To check which are the ineligible input tax credit that they have claimed, they can have a special audit done. If they feel that the value of supply that they have computed for all the supplies made might be wrong, or for in a particular month might be wrong. So to determine the correct value of supply, they can have a special audit done, right? So in those special circumstances, special audit will be ordered by the department. It will be the accounts will be audited by a chartered accountant or a cost accountant, empaneled. It should be completed within 90 days. Extension of another 90 days will be available. That auditor will have to issue an audit report based on the findings of his. And based on the audit report, same proceedings under 73 or 74 can be initiated by the department. The expense of such audit, including audit fees, will be borne by the department. The commissioner will pay. Yes. That's it. This is the discussions on assessment and audit. Understanding? Yeah. The next one: inspection, search, seizure, arrest. Right? A small discussion. This is procedure based. At the time of inspection, at the time of search, at the time of seizure, what are the procedures that they have to follow? That is what is mentioned here. Okay, procedural based. In case of contravention, right, in relation to goods, as per section 130, they can confiscate the goods as well. They have the power. Department has the power to confiscate. Confiscate is transferring the title of the goods to the government. Correct? Confiscation of goods. Then once the goods are seized, right? How will they? What are the different modes in which they will release it? They can release it. First one is on provisional basis. You either paying the tax or giving security, they'll release the goods. Second, actual return. If there is no action taken within 60 months of such seizure, etc., then they have to release it, actual return. Disposal of the goods, specifically in case of perishable goods, hazardous goods, then they'll dispose it of. Right? These are the three modes of release. And coming to offenses, there are two types of offenses, cognizable offenses and non-cognizable offenses. That depends on the amount of offense involved. Right? If the tax evasion, wrong ITC availed, wrong refund claimed, etc., exceeds 5 crore rupees, then it is cognizable and non-bailable. That is, courts suo motu can take action without any written complaint, and bail will not be, arrest can happen without warrant. Right? Cognizable and non-bailable. Whereas all other offenses are non-cognizable and bailable under GST law. Only if the amount tax evasion exceeds 5 crore, it is cognizable and non-bailable. Yes. The next discussion, next chapter that we discussed was demand and recovery. In demand and recovery, we discussed two sections. First part is demand, two sections, section 73 and 74. Right? Under 73 and 74, the difference between 73 and 74 is section 73 is for normal scenario due to inadvertent mistake or error. Whereas for section 74, it is
Fraud.
fraud. Yes. Now, the importance of these two sections that we have to learn or that we have to revise is the time limits that are there. Under section 73, show cause notice have to be issued within
5 years from the
5 years. 73. Under 73, it is 3 years. 3 years from the due date of annual return, order has to be passed. Due date of annual return, order has to be passed. Notice have to be issued 3 months prior to that date, meaning 2 years, 9 months. 2 years, 9 months from the due date of annual return. Whereas under 74, order has to be passed within
5 years.
5 years. Yes. 5 years from the due date of annual return. Notice have to be issued.
4 years, 6 months.
Yes, very good. 6 months before the order. So 4 years, 6 months from the due date of annual return. Now, next important difference with regard to 73, 74 is penalty. Right? Important discussion. Penalty. In relation to penalty, in case of 73, before issuance of show cause notice, what is the penalty?
nothing.
If tax is paid, nil. If tax is paid before issuance of show cause notice, nil. If tax is paid up to 30 days after issuance of show cause notice,
No penalty.
yes, again penalty is nil. If tax is paid beyond 30 days of issuance of show cause notice, beyond 30 days of show cause notice and up to 30 days of order,
10%.
yes, it is 10% of tax or rupees
Or 10,000.
10,000, whichever is higher. Same way, penalty if amount is paid beyond 30 days of the order,
25%.
same 10% or 10,000, whichever is higher. Okay, why did I bifurcate like this? Because under 74, we have these bifurcations. Yes, under 74, we have these bifurcations. Under 73, we have only two rather. Whether tax is paid within 30 days of issuance of show cause notice or not. If it is issued within 30 days, zero penalty. If it is issued paid beyond 30 days, then irrespective of when you pay, it is 10% or 10,000, whichever is higher. Whereas under 74, if tax is paid with before issuance of show cause notice, what is the penalty?
No penalty.
It is 15%. 15% of the tax before issuance of show cause notice. Once show cause notice is issued, if you pay within 30 days, at 10 more percent, 25% of the tax. If you are paying the tax beyond 30 days of issuance of show cause notice, but within 30 days of the order being passed, 50% of the tax. If you are paying the tax beyond 30 days of the order being passed, it is 100% of the tax. 100% of the tax. So these are the different penalties that we have in case of 74. Right? There were timelines depending on the timelines. Are we clear? Yes. Then, if you have collected any amount but you have not paid it to the government, in that case, there is no time limit to issue show cause notice. Amount collected but not paid. No time limit to issue show cause notice. But once the show cause notice is issued, order has to be passed within 1 year from the issuance of show cause notice. Yes. Similarly, if you have not paid self-assessed tax, for non-payment of self-assessed tax, again, am I audible, guys?
Yes.
Now
Yes.
audible.
Yeah, now audible. Yes. For non-payment of self-assessed tax, show cause notice itself is not required. Directly recovery proceedings can be initiated. Whereas for tax collected but not paid, show cause notice have to be issued, but there is no time limit. Yes. Then next, recovery proceedings. So this is about demand. Next, coming to recovery proceedings. In case of recovery proceedings, there are different ways in which you can recover. Right? When can the recovery proceedings be initiated? After the demand order is passed under 73 or 74, when can the recovery proceedings be initiated? We have discussed this in the class.
When the demand is admitted.
When the demand is
Admitted.
admitted. So when do we consider that the demand is admitted? What is the time limit?
3 months from the date of issue of order.
Yes, 3 months from the date of communication of the order. That's what the law says. Because 3 months is the time limit for appeal. Correct? So 3 months is the time. So after 3 months, they can initiate recovery proceedings. There are different ways, right? If the department has to pay you some money, deducting that money by deduction from any money owed, sale of goods under the control of the proper officer, garnishee proceedings by if you have to receive money from some third party, debtors, ask the debtor to pay you. Bank, if you have amount in the bank, correct? Then sale of movable or immovable property. Collecting is as arrears of land revenue with the help of district collector, as a fine imposed by magistrate with the help of magistrate, then by as if it is an execution of order passed by a court decree with the help of civil court, then in the form of surety. These are the different ways in which recovery proceedings can be made. Now, in case of a demand being paid, can the taxpayer pay such demand in installments? Yes, that option is available, for which he has to give an application, make an application to the commissioner. If he is satisfied about the financial difficulties, yes, they will give option of installment. However, no installment facility if the total demand itself is up to 25,000. Right? It's a small amount, they say. And there should not be any default in payment of taxes earlier. He was given an option of installment arrear, he defaulted, etc. In those cases, you will not be given installment facility. Yes. And as a part of recovery proceedings, they can attach your property as well. Correct? Immovable or immovable. So that property, when it is attached at the initial stage, it is called provisional attachment. Once there is a provisional attachment made, if you pay the taxes, that attachment should be released. However, if provisional attachment made, no further action taken, that provisional attachment will be valid only for 1 year, reset amendment. Right? So within 1 year, it should be released. If there is no action taken by the commissioner after provisional, see, after provisional attachment of the property is made, they have to take further action. What is the further action? They have to value that property. They have to determine the total value, amount that they have to recover, right? Sell that property, recover the amount, and surplus, if any, should be given back to the taxpayer. If these things is taken care, then fair enough. If it has just provisionally attached, put a notice on the property that this has been provisionally attached for by the GST officer so and so, and they have kept quiet. If that is the case, if 1 year is expired from the date of provisional attachment, that attachment will be released. Okay, so they cannot do it at their own will, right, at their own convenience. No, there is a time limit brought in now. Yes, this is about recovery proceedings. The next discussion, the next chapter is liability to pay in certain cases. They have covered various scenarios. In case of transfer of business, what happens to the liability which was there till the date of transfer? It would be liable, both the seller and buyer, both will be liable. In the case of an agent and principal, for the transactions made by the agent, both the agent and principal will be liable. Then in case of amalgamation and merger, who will be liable? In case of a company in liquidation, what happens? In case of a company in liquidation, as soon as a liquidator is appointed, he has to intimate all the tax authorities. Even in Companies Act, we have discussed this. Even in IBC, we have the same thing, right? So they have to intimate, the liquidator has to intimate all the tax authorities within 30 days of his, appointment as a liquidator. Why? If the tax departments have any demand due, they have to intimate back, correct? So the commissioner will have to estimate the tax payable and intimate back to the liquidator. And after the company is liquidated, will the directors of the company be liable? The answer is yes, especially in case of private limited company. Directors will be jointly and severally liable. Yes, in case of a partnership firm, partners are jointly and severally liable. And in case of a trust, guardians or trustees, the court of wards related, right, who will be liable? The persons who are in charge of that trust, who in charge of that ward, so they will be liable. Upon death of a person, the legal representative will be liable only to the extent of
His estate.
yes, the estate of the deceased, only to the extent of estate of the deceased. Perfect. Then, in case of partition of a HUF, dissolution of the firm, the liability will remain. Right? Just because firm is dissolved, liability cannot be dissolved. Till liability which was existent will remain. And in case of discontinuance of the business, whatever was done till the date of the discontinuance, the liability will continue. Okay, these are the different discussions in case of liability to pay. Small discussion, not so important for us. Next, the chapter that we learned was offenses and penalties. There were multiple penalties that we had. Section 122, 123, 124, 125, 126. Correct? Different penalties. 122 had 5 different discussions. 122 1, 1A, 1B, 2, and 3. 122 1 penalty is applicable for taxpayer, taxable person. Section 122 1 is for taxable person for violations. So here the penalty is same as 73 penalty, 10,000 or the tax evaded, whichever is higher. 1A is any person other than the taxpayer who has retained the benefit due to such violation, who got the benefit, beneficiary who retained the benefit, penalty will be equal amount of tax evasion. Equal amount of tax evasion. 1B is penalty for e-commerce operators for violation. For example, we have discussed that as an e-commerce as a supplier of goods, he can, even if he is unregistered within the threshold limit, he can register with e-commerce operator, list with e-commerce operator, supply through e-commerce operator only intrastate. It's the responsibility of the e-commerce operator to ensure that there is no interstate transaction of that supplier. If there is a violation, penalty to the e-commerce operator under 122 1B. Same 10,000 or tax evaded, whichever is higher. Then subsection 2 is for registered person who supplies goods without payment of tax. In that case, they'll check whether it is a case of fraud. If it is a case of fraud, penalty will be same 10,000 or tax due, whichever is higher. Whereas if it is not fraud, mistake, in that case, it would be 10,000 or 10% of the tax due, whichever is higher. So not 100% of the tax, 10% of the tax. Under 73, we had 10%, right? Same, 10% of the tax due, whichever is higher. Are we clear? Then last one, subsection 3. Any person who assists in contravention. 25,000. Now, whatever I am telling the amount, this is under CGST Act. Equivalent amount in SGST will also be there. If it is an offense in IGST, double. Clear? Then we have one more, section 125, which talks about general penalty. If there is no penalty specified for any of the offenses under the law, then come to this general penalty, which is up to 25,000 under CGST and SGST, as the case may be. Next section. However, the section 126 gives us a guidelines for levying of penalty. They say for minor breach, no penalty. What do we understand by minor breach? Up to rupees 5,000. Tax evaded up to rupees 5,000, then no penalty to be levied. That's what section 126 says. Then we have penalties for detention of goods on conveyance. Right, at the time of transportation, if they catch hold of the vehicle and they find that there is no documentation, proper documentation, in that case, what is the penalty? It depends on, we had discussed two different discussions. When we had solved a problem also on this, when owner comes forward to pay the penalty, when owner does not come forward to pay the penalty. When owner comes forward to pay the penalty, owner of the conveyance comes forward to pay the penalty, if it is a taxable goods that is being transported, 200% of the tax is the penalty. If it is an exempt goods, then 2% of the value of the goods. If it is IGST, 4%. 2% of the value of the goods or rupees 25,000, whichever is less. Meaning maximum 25,000. However, if owner does not come forward, in that case, in case of taxable, right? If it is taxable goods, it would be 50% of the value of the goods or whatever was there in the right left hand side, 200% of the tax payable, whichever is higher. That is, minimum you have to pay 200% of the tax as penalty. It can go up to 50% of the value of the goods as well. Okay. Now, normally, which would be higher? 50% of the value or 200% of the tax?
50% of value of goods.
Normally 50% of the value of goods. However, if the goods is taxed at 28%, 200% of that would be 56% of the value, right? In that case, 200% of the tax would be higher. So that's the reason they have brought in both 50% of the value or 200% of the tax, whichever is higher. If it is exempt, there it was 2%, here it is 5%. 5% of the value or 25,000, whichever is this. Then the next discussion that we have is in relation to section 138, compounding of offense. Right? Any offense under the law, under GST law, yes, it can be compounded unless it is non-compoundable, unless the penalties are fine and imprisonment. That is basically more than 2 crores. Right? Arrest can be made only in case of value of offenses more than 2 crore. Correct? So below 2 crore, it can be compounded. Now, in case of compounding of offenses, you have to make an application for compounding. You have to bring in all the true facts of the case, and depending on the facts and circumstances of the case, the officer will charge a compounding fee. That compounding fee can be anywhere between 25% to 100% of the tax. Right? 25% to 100% of the tax. And recently they have notified the compounding amounts as well. Right? The compounding amounts depending on the offenses. Offenses under 132(1)(a), 132(1)(c), 132(1)(d), different compounding amounts have been prescribed, 75%, 50%, etc. But it should be within 25% to 100%. Clear? Yes, that is about offenses and penalties. We also have a small concept there where ethical aspect, right? Ethics on by practicing professional, especially for chartered accountant that they are talking about. There are various certifications under GST law. So when issuing the certificates, we have to be ethical. Those things have to be whatever we would have learned in professional ethics, right? That those aspects have to be complied with. That's one small discussion that is there in that chapter. Yes, the next chapter that we have, appeals and revision. These are two different discussions, correct? Appeals and revisions. Appeals can be filed by aggrieved party, the taxpayer normally. In some cases, appeals can be filed by the department also as a review application. If the commissioner feels that the order passed by any of his subordinates is wrong, then he can file an appeal on that. It's called a review application, right? Taxpayer to file an appeal within 3 months from the communication of the order. Department, 6 months. Appeal will be in GST APL 01. If it is department, APL 03. Correct? To whom it has to be filed? It has to be filed with the appellate authority. Commissioner appeals or joint commissioner appeals. Same way, revision. Order passed by the subordinates can be taken up by a revisional authority for revision. They can look into the order, and if they feel that it has to be revised, again, certain circumstances only, it can be taken up for revision. 3 years time available for them, right? So that revision will be taken up by revisional authority. Once it is with the revisional authority or appellate authority, order passed by them can be filed with appellate tribunal, GST 80. Right? GST 80 within again 3 months, same time. Within 3 months, GST APL 05. Now, in the first appeal for the taxpayer, when he makes an appeal, is there any pre-deposit?
10%.
Yes, 10% of the tax. right? Disputed tax. If it is not disputed, you have to pay in full, 100%. Disputed, 10%. 10% of the tax pre-deposit, then the balance demand will be stayed. Correct? That's what the concept is. Yes. So 10% would be the pre-deposit. Whereas for the departmental appeals, no pre-deposit. In case of GST 80, along with APL 05, what is the pre-deposit?
Additional 10%.
Yes. So in total, 20% of the tax. Right? So if you have already paid 10, pay the balance 10% here. 20% of the tax. Order passed by GST 80 can be divided into two. One, order passed by the principal bench of the GST 80, New Delhi. Then order passed by the other benches. Order passed by the other benches can be appealed with the High Court, jurisdictional High Court, if it involves, very good, substantial question of law. If it involves substantial question of law, within 180 days, you have to file that appeal in GST APL 08. Order passed by principal bench and order passed by High Court directly to Supreme Court. If the principal bench or High Court, while passing the order, they have certified that it is a fit case for appeal with the Supreme Court, then appeal with the Supreme Court can be made. Clear with this? This is the what do you say, the summary of this chapter of appeals and division. That's it. Okay, this is what is there. Others are procedural based. What are the things that they have to take care at the time of appeals? Those are the discussions that we had. But this is important. They can ask MCQs on this, right? So the time limits, the pre-deposits, the forms, right? The hierarchy in which the appeal should be made. So these things can be asked in the exams. Yes, section 107 talks about the appeal, correct? The first appeal. 107 is the first appeal. 112 is for appeal with GST 80. 117 is with appeal with High Court. 555 at increase. Yes. Next concept. The next concept that we have, the next chapter is advance ruling. Now, again here, we are not, there are ambiguity in relation to a particular question, issue, and we do not want to take a chance in relation to the same. So we want to have the clarity. In such cases, what do? We make an application of advance ruling. With whom? With authority of advance ruling, Chandan. Correct. So with authority of advance ruling, we'll make an application. Am I audible properly?
Yes, sir.
Yes. Authority of advance ruling. That authority of advance ruling will be constituted under State Act, SGST law. The same authority will be taken for CGST questions as well. Right? So all the questions can be, any issue can be looked into by the authority of advance ruling, except those issues on which the proceedings are pending, those issues on which the proceedings have already been decided, and questions related to place of supply. Yes, correct. Questions related to place of supply, no advance ruling can be made. Now, once the advance ruling is applied for, if the order passed by the advance authority of advance ruling, if you are not satisfied with that, you can make an appeal with AAAR, Appellate Authority of Advance Ruling, or if the authority of advance ruling, the members of the authority, the two members, if they have difference of opinion, then instead of them passing the order, they can refer it to Appellate Authority of Advance Ruling. Right? If Appellate Authority of Advance Ruling also is unable to come to a conclusion, then they say there cannot be an advance ruling in relation to that issue. Okay, there cannot be an advance ruling in relation to the issue. So only if there is an authority, authoritatively they can conclude, only then they will pass an order. If not, they say, no, there is no advance ruling possible in relation to that issue. Yes, the last chapter that we discussed under GST was miscellaneous provisions. right? In miscellaneous provisions, there were multiple discussions. Most of them were procedural based. For example, documents. When we are issuing the submitting the documents with the department, it need not always be hard copy. Even the soft copy documents are allowed. That's what they say, right? Documents definition and admissibility of microfilms, facsimiles, computer printouts are allowed. And we also discussed about consent-based sharing, section 158A. Rule 163, which has been notified now recently, right? Consent-based sharing of information in relation to returns filed, GSTR1, GSTR3B, etc. The consent of the taxpayer has to be obtained by the respective authority before sharing the information. However, while giving the consent, the taxpayer, when he's giving the consent for sharing the information of GSTR1, the information of his recipients are also there in that GSTR1. So he has to obtain the consent of those recipients as well before giving the consent. So in relation to this accounts aggregator, which is an NBFC, has been notified as that authority which will look into these consent sharing provisions. That is mentioned in Rule 163 for 158 consent-based sharing. Then we also discussed about anti-profiteering measure, for which National Anti-Profiteering Authority was established with effect from 31st of December 2022. They have abolished NAAA, and Competition Commission of India itself will look into the anti-profiteering provisions, right? So we also discussed the procedure. Initially, the state level standing committee will look into based on their initial verification of the case. If they find that yes, prima facie there is a case, then they will pass it on to the National Anti-Profiteering Authority. Once the order is passed by them, then penalty will be levied. If they find that yes, there is anti-profiteering being done, if the profit is not passed on to if the benefit is not passed on to the customer, then penalty will be levied. Correct? That's the procedure that we discussed. Yes, these were the different concepts that we had in the syllabus. Correct? So this entire overview of the GST that we have learnt. Any doubts in this? No, we have gone in depth, right? We have discussed in depth all the provisions with regard to GST. Yes. Now, what we can do, we'll take a break, a quick break. After coming back, we'll quickly discuss the customs part of it. Okay, the small discussion again. We'll not we need not go in depth there because only the important aspects we have to discuss. And more of it, when you look into the examination in Customs Act, customs related calculations are important. Calculation of assessment, assessable value, right? Those discussions are there. That anyhow we'll be discussing when we are discussing the case studies, right? How do we solve it? How do we calculate the assessable value, etc.? We'll be looking into it. Okay, we can do that. We have valuation rules, baggage rules, etc., which we can look into after the break. Before that, in GST, anyone has any doubts? No, good to go. Okay, right then. We'll take a break, guys. Can we come back at 8:55?
Yes.
Yes, we'll continue with customs at 8:55. Thank you.
Thanks.
Thank you.
Yes, friends, are we all back? Yes. Fine. So we have completed the discussion on GST. So we have few small discussion on customs. We'll finish that, and later we'll be left with discussion on law and case studies to be discussed. Right, in my classes at least. So we'll see once the customs is done. Before taking up law, we'll see whether we can discuss some of the case studies where law is not discussed. So the case studies we can discuss and then go to law. How it can work, we'll see. Okay, so just discussing only the concepts might be boring, so we'll shift some case look into some case studies and then come back. Okay, before that we'll first finish the customs part. So today we'll be discussing most of the customs part will be discussed. Possible it can be discussed, balance whatever is left we can discuss in the next class. Okay, now we have in relation to customs and the FTP, that part of to start with, we have levy and exemption of customs, correct? Section 12 of the Customs Act, charging section. So before we discuss section 12, there are a few what do you say, the terminologies that we have to know, the definitions. To start with, we have territorial waters. From the baseline, what is the distance of the territorial waters? What's the area?
12 nautical.
Yes, 12 nautical miles. Whereas Indian customs waters will extend up to
200. 200 not.
yes, exclusive economic zones, right? 200 nautical miles. Yes. Now, when do we say vessel has entered into India? When it enters
Customs. Territorial waters.
the territorial waters. Yes. Now, with regard to the levy and exemption, the stages at which it works, there are 3 stages. First stage is the levy stage. Second stage is the assessment. And the third stage would be the collection. Correct? Levy, assessment, and collection. To start with levy, section 12, charging section, taxable event under Customs Act is import or export of goods. Right? Either import or export. Yes. Now, with regard to this, with regard to imports, we have 2 types of clearances. One is clearance for home consumption, clearance for warehousing. In case of clearance for home consumption, the customs duty will be paid at that point. Duty will be discharged, and the goods will be taken for out of the customs station for home consumption. Whereas in case of clearance for warehousing, we will not be taking it out for home consumption at that point. So it will be kept in the warehouse in the customs station. So duty payment also will be deferred. Collection of the customs duty will also be deferred. It will be done at the time of clearance for home consumption subsequently. Yes. Then in some cases, what happens to the customs duty? For example, re-importation of the goods which were exported. Right, goods imported into India after exportation, do we have to pay customs duty on that?
Yes.
Yes, but concessions allowed, right? Concessions are there. Yes, if the goods which we are importing back, which were exported earlier under duty drawback scheme, where we had received drawback, in that case, to the extent of duty drawback received is the amount of import duty, the customs duty that we'll be paying now. Then if we had sent the goods outside India for repairs abroad, after repairs, if we are bringing it back, then to the extent of the repair expenses, the cost of the repairs, on that customs duty will be payable. Similarly, for all other goods re-importing after export, customs duty payable will be nil. Right? Only in case of duty drawback and in case of repairs, we will be paying the customs duty. Yes. However, to avail these concessions, conditions have to be satisfied. You have to re-import within 3 years. Further extension available, 2 more years. Right? And same goods, whatever was exported, have to be re-imported, and there should not be any change in the ownership of such goods at the time of re-importation. Yes. And if you had exported, you're re-importing it for the purpose of repairs. Once repair is done by you here, you'll again re-export it. Then what is the time limit for re-exportation?
6 months, sir.
Very good. Correct. 6 months is the time, right? Within 6 months, it has to be re-exported. Similarly, section 21 talks about goods which come into India as part of derelict, wreck, in that case, jet lag. So in that case, as if, what would be the treatment? Under customs law, it will be treated as if the goods are imported into India. However, if the proper officer is satisfied that such goods have to be admitted into India without duty, then it would be admitted duty-free. Exemption would be given only upon the satisfaction of proper officer. General rule, normal import, normal provisions of the import duty will be applicable on such goods. Yes. We also have a provision on a special rule, which was new rules which were introduced in 2022. Import of goods at concessional rate or for specific end use rules 2022, for which the importer has to make an application, right? He has to file a one-time prior information for which he'll be allotted IIN, identification number would be allotted for him, and for that concessional rate for specific purposes end use that he is using, he has to give a surety or a bond, correct? And he has to re-export that goods which he is importing within 6 months from the date of import. If these conditions are satisfied, then he can import using that IIN number at a concessional rate. That's the rule. Then what is the date? See, for payment of tax, there will be rates, customs duty rates. What is the date on which I have to check the rate? And we have to convert, to calculate the assessable value, we have to convert the currencies. What is the date on which I have to convert the currency? Right? For that, it depends on whether we are looking it for home consumption, whether we are keeping it for warehousing. So if the goods are kept for home consumption, goods are cleared for home consumption, then
Date of bill of entry.
yes. So goods intended for home consumption, being entered for home consumption, in that case, the rate and valuation as on the date of bill of entry or date of entry inward coming into India, date of entry inward, whichever is later, right? Whichever is later, that date. Now, if bill of entry is later, bill of entry date. If entry inward is later, entry inward date. If it is clear for home consumption from warehouse, at the time of keeping it for warehouse, we are not bothered about the rate and the valuation because customs duty is not assessed at that point. Correct? So only when it is cleared for home consumption from warehouse, cleared for home consumption from warehouse, here entry inward has already happened. Right? So we need not look into entry inward. Directly consider date of bill of entry. See, entry inward would have already happened earlier. It came into India, then we kept it in the warehouse. Correct? So, obviously, date of bill of entry will always be the later date. So, consider date of bill of entry. In other cases, date of payment of duty. That would be the date on which you have to you're checking the rate and valuation. Okay, this is the dates, reference dates to be considered. Then, next one, rebate, abatements, and remissions and exemptions, right? The different provisions that we have. With regard to that, first one that we have is section 13, which talks about pilfered goods. In case of pilfered goods, what happens? Law says complete exemption. No duty has to be paid on pilfered goods. However, pilferage should have occurred when?
It's with the custodian of the
Before and after unload.
Yes, after unloading and before
Clearance.
clearance, order for home consumption. Yes, before order for home consumption. During that period, pilferage should have happened. Then complete exemption from payment of duty, section 13. Whereas section 23 talks about remission in case of goods lost or destroyed. This should be a complete destruction beyond repair. right? Complete destruction. When I say destroyed, so lost or destroyed when? Before clearance for home consumption. Before clearance for home consumption, then what do they give? Remission from the duty. The difference between these two, right? In case of goods lost or destroyed, even if it is destroyed in the warehouse, I'll get the remission. Right? Even if it is destroyed in the warehouse is also covered there. Destroyed in the warehouse, I'll get the remission from the duty. Yes. Here, why there is no complete exemption? Because only to the extent of destruction, only to the extent of goods being lost, you will have reduction in the duty payable. Remission from the duty. Yes. Next one, abandonment, right to relinquishment. You have received the goods. When you received the goods, you got to know in the customs station that this is not as per the specification. This is not what I ordered. In that case, if you want to take it back, what you have to do? You have to pay duty. Correct. You have to, if you have to take it out, you have to pay duty. You have to send it back. That is the exporter's headache to take it back. As an importer, you can relinquish the right, give up the right on that. If you relinquish the right, no customs duty payable, right? Abandonment of the goods. So it might not be as per specification, damaged goods, there is a breach of contract. So if there is relinquishment, then there is no duty. Similarly, on damaged goods or deteriorated goods, you'll get abatement. What do we understand by abatement? Discount in payment of duty, reduction in the value, correct? So if damage happens before or during warehousing, by accident after unloading but before assessment, by accident in the warehouse before clearance, then abatement will be available. When abatement will be available? Abatement for on damage in 3 circumstances. One, before or during unloading in the station, or after unloading but before assessment, or in the warehouse before clearance. All these should be accidental. Obviously, intentional damages will not be given. Before clearance, for all these, abatement will be given. What is the abatement available? The formula is there, right? Abatement will be total duty on such goods before damage. That is normal duty. If there was no damage, what is the total duty payable? Multiplied by value of the damaged goods divided by total value of the goods before damage. Proportionate, basically. Total value of the goods before damage. Are we clear? Yes, total value of the goods before damage. So proportionate abatement in the duty reduction would be allowed. Section 25 tells us you will also get exemption from payment of duty. That exemption can be general exemption or it can be a specific exemption, special exemptions. Orders passed by the department, correct? And we also have 25A and 25B special scenarios, exemption for inward processing of goods, exemption on imported goods for outward processing. This is inward processing, this is outward processing. Exemptions in specific circumstances based on rules. Okay, that's what 25, 25A and 25B is all about. Okay, this is levy and exemption. Clear? Then, what if it is duty leviable for duty? What are the different types of duties that can be levied? First one that can be levied is basic customs duty, BCD. Right? So BCD will be levied on the assessable value under section 14, the valuation as per the valuation rules. So how do you determine the customs duty rates? The rates will be specified in the schedules. There are 2 schedules to the Customs Act. Schedule 1 talks about rate of import duties. Schedule 2 talks about the rate of export duties. Correct? And schedule to the customs tax. However, what is the standard rate of BCD? Standard rate is 10%. Right? However, for certain cases, there are preferential rates also notified. Conditions have to be satisfied. Many things are there for that. Preferential rate of duty. That's the first type of duty that can be levied. Second, IGST, integrated tax, right? Proviso to section 5(1) of IGST Act. By virtue of that, the Customs Act has the power to levy IGST. Normal, it depends on the rate of IGST depends on the goods being imported. Then, in some cases, along with IGST, even compensation cess will be levied at the rates notified. Now, for the purpose of calculating IGST and compensation cess, what is the value? Value will be the assessable value as per section 14 that you would have computed for the purpose of calculating BCD. To that, I have to add BCD. Yes. Assessable value plus BCD on this will apply the GST rates. Correct? That is the value on which IGST and compensation cess, as the case may be, will be computed. Next one, additional customs duty. Additional customs duty under section 3(1). This is applicable basically to counter the taxes payable on the like goods manufactured in India. Like goods manufactured in India. Similarly, countervailing duty, special additional duty under section 3(3) for countering excise duty. Wherever excise duty is not applicable now, with the introduction of GST, wherever these duties are not applicable, then that additional customs duty and CVD will not be levied, because GST is anyhow levied, correct? Whereas for some goods, still additional excess duty and VAT are still levied. For those, additional customs duty and CVD will be applicable. Then special additional duty under section 3(5). This is to counter sales tax, VAT, etc. Local. Then protective duties to protect indigenous industries in the country. Now, if we import certain products, that might affect the small industries in the country. So to ensure that doesn't happen, they'll levy these protective duties so that the price of the imported goods will be higher than the prices of the domestic products. Correct? So that is protective duties. Under protective duties, we one have CVD on subsidized articles. Now, for a particular goods that we are bringing into India, importing into India, there is subsidy given in one of the countries. So from the imported country, there is subsidy given. So obviously, the amount at which we'll be importing will be lesser. But for that product, no subsidy in India. So in local market, it will be higher. So to compensate for that, CVD will be levied, countervailing duty. Then ADD, anti-dumping duty. In some cases, they will send goods into India at a price which is lesser than the domestic market price of that country. Domestic market price of that country is as a dumping yard. In the country, India will be considered as a dumping yard for that particular products. So that will also affect the small businesses in India. In such cases, to counter that, anti-dumping duty. Now, when will anti-dumping duty be levied? When export price of the product imported into India is less than the nominal value of the like articles in that domestic market, of the exporter country. In domestic market of exporter country, if this is there, this is called dumping. This concept is called dumping, right? In relation to that, this difference, right? Export price, the nominal value of that country minus the export price, that difference is called margin of dumping. That difference is called margin of dumping. So if the nominal value, if they are selling in INR terms, if they are selling it at 1000 rupees, if they are sending into India at 900 rupees, 100 rupees is the margin of dumping. Right? Margin of dumping or injury margin. What is this injury margin? Injury margin is the amount that is required to cover the injury for Indian market. Now, for the same product, in Indian market, if it is selling at 960 rupees, then I need not levy the 100 rupees as anti-dumping duty, because even if I levy 60 rupees, injury to the domestic market is covered. The product will be 960 rupees. Correct? Product is being brought into India at 900. In domestic market, it is sold at 960. So everyone will import at 900 itself. Injury to the market. So what is the amount that I have to increase to cover the injury? 60 rupees. So that the imported product will be on par with the domestic market, domestic product. So that difference is called injury margin. The amount margin required to cover the injury. So anti-dumping duty will be margin of dumping or injury margin, whichever is less. Okay, that's the formula. Margin of dumping or injury margin, whichever is less. Understanding? Yes, these are the different types of duties. Okay, duties that can be levied. Now, okay, so these are the duties that they have levied. They have passed an order also, assessment at the time of importing, at the time of clearance for home consumption. But you are aggrieved by the order passed. You feel some of the duties that they have passed, let's say anti-dumping duty or whatever, the calculation of it, you're not agreeing with it. You're saying it's too much what they have computed. So in that case, what you can do, order passed by the Commissioner of Customs, appeal. Appeal to SysStat. Appeal can be made with SysStat. Fees of 15 rupees per application. You have to make appeal within 90 days of the order passed. Within 90 days, make an appeal with the SysStat. Yes, in addition to these different types of duties, there is one surcharge that is levied. Social welfare surcharge. Right? Earlier, they had education says, secondary education says, multiple things like income tax. So now, in income tax also, we have HEC, all other cesses merged together. Same way, all cesses merged together, they brought social welfare surcharge. Social welfare surcharge, normally the surcharge rate is 10%. Now, for calculating this surcharge, what would be the value?
BCDs.
BCD and GST. IGST, compensation cess if any. So on this 10%. Clear? Yes. So on BCD and GST, the social welfare surcharge will be levied. Along with this surcharge, there is one cess for certain items that is called agriculture infra and development cess, infrastructure and development cess. This is only on notified products, not on all. Okay, agricultural infrastructure and development cess. Social welfare surcharge is applicable for all, but agriculture infra and development cess only for certain notified items. Okay, these are the different types of duties. Getting a reasonable idea? Yes. Next one, the next chapter that we have, next discussion, classification. Why do we need to have this classification? To determine the import duty rates, basically, correct, similar to GST. Now, basically, GST goods are valued, rather classified based on HSN, and the HSNs under GST are taken from Custom Tariff Act. So that is under this. So we classify the goods under customs law based on HSN, Harmonic System of Nomenclature, which is again the global classification with some modification that we have done to suit the Indian market. HSN. As I said, first schedule will be import, second schedule will be exports. But there will be confusions for us in classification given in the schedules based on HSN, first schedule and second schedule. So for that, to avoid confusions there, we have rules of interpretation. right? For both the schedules, schedule 1 and schedule 2, they have given us rules of interpretation to ensure that there is smooth classification possible in case of goods. Okay, so for that, there are multiple rules. Rule 1 is general one. Rule 2A says if you have incomplete or unfinished goods, that has to be classified as its full completed or finished goods itself in the same category. That is rule 2A. Rule 2B says if you have combination of the goods, then it has to go with the same as the main material in that combination, main goods involved in that combination, same category, right? So similar kind of composite supply, principal supply concept. Then rule 3 talks about if one particular goods can be classified under two headings, two or more headings, multiple headings. In that case, which is the heading to be chosen? For that, there are 3 rules. One, specific over general. These are rules. We also have this in interpretation of statutes, right? Specific over general rule. So specific over general. So out of those 2 entries, which is more specific? Go with that. Second, if that is not possible, essential characteristic principle. So which of the entries give you the correct, more appropriate characteristic of that particular product, goods? Then third one, if that is also not possible, latter the better. Which comes at the last end. That would be the correct classification. Go with that classification. If these rules, whatever we discussed, right? Rule 1, 2, 2B, 3 is not applicable, not possible for classification. Then we have rule 4, akin rule. That is, most appropriate goods are classified in which entry? Most like goods go with that classification. That is what rule 4 says. Rule 5 is for classification of packaging, containers, etc. Talks about containers classification. Then rule 6, rule 7 are pretty simple, easy discussions. Then we have what is the next discussion that we have in classification with regard to exports. Exports also we have same classifications, schedule 2, right? Same rules of interpretation is what we will be having. Okay, these are the rules of interpretation for classification. But for us, more than this classification, important is valuation. Why valuation is important? Because tax rate will be applicable on this value that is assessed. Correct? Now, how do we value? Same concept as we have learned in section 15 of GST. They say go with the transaction value. Transaction value. And this transaction value includes incidental expenses. Correct? All those incidental expenses. 15.2 in GST, same concept. Incidental expenses. However, what is the conversion rate that we have to apply? The rate which is applicable on the date of filing the bill of entry in case of imports, filing the shipping bill in case of exports. And which rate we have to consider? Which rate should be considered?
Notified by CBIC, sir.
Yes, CBIC notified rates have to be considered compulsorily. Okay, CBIC notified rate. So in exams, they can give us CBSE notified rate, RBI reference rate. Both can be given for conversion. So in that case, we have to consider CBSE rate only. Yes. Then in relation to valuation for imports, again, transaction value is there. But what if we are not able to get the transaction value? They have given us rules. Rule 4 says, if you are not able to get the transaction value of that product, go with the value of identical goods. Transaction value of identical goods to be considered. It should be when I say identical, it should the import should have happened at the same time in the same commercial level. Only then it would be identical. If it is not, then accordingly adjustments have to be made. If no identical goods available, go with similar goods with adjustment. If that is also not possible, then go with either rule 7 or rule 8. Rule 7 says deductive value. Rule 8 says computed value. Right? Different ways in which it can be valued. If this is also not possible, rule 9, residual, best judgment. Residual method. Having said that, in the valuation, we have to consider certain costs. For example, freight, insurance, right? For which we have the concept of FOB and CIF, correct? Now assessable value for the purpose of valuation under customs will be FOB or CIF?
Yeah.
CIF, because it says transaction value including all incidental expense. So it has to be CIF, correct? So if they have given us FOB, then we have to add all the expenses incurred to get the CIF. However, if cost of freight is not ascertainable, then it should be considered as 20% of FOB. If insurance is not ascertainable, it should be considered as
1.125%.
yes, 1.125% of FOB. Right? These two percentages are important for calculations can be asked. So 20% of FOB, 1.125% of FOB. Yes, these are some of the provisions for import computation of value under imports for imported goods. Then we have a concept even in GST also when we were discussing for exemption from e-way bill. We discussed from customs port to ICD or CFS, inland container depot, then CFS, container freight stations. What is this ICD and what is this CFS? What is the difference between these two? In container depot, ICD, these are nothing but custom stations only. Okay, these are custom stations for unloading the goods and loading the unloading imported goods, loading exported goods. So this can have independent existence. And complete customs process can happen in this. So it is as if a custom station. But the only difference is it will be inland container depot. Right? So complete customs process can happen. So it is as if a custom station. Whereas a container freight station, this is not a custom station for unloading and loading. It is a part of a custom station only, a part of a customs area, under the jurisdiction of the customs officer. Under the jurisdiction of customs officer, why are they doing this CFS? Only to decongest the main customs port. Decongest the customs station. So how will this help in decongesting? They'll do examination of the goods in this. So instead of doing examination in the customs station, which would take more time, which would block the goods, take it to CFS, complete the examination and bring back to the customs station so that decongestion happens. So only examination, not the complete process, right? Clearing for home consumption, etc. will not happen in CFS, whereas ICD, it will happen. So only examination of goods happens in CFS. Therefore, no independent existence. CFS do not have independent existence. It's only a part of the customs area. Only part of the process happens. Clear with this? Yes. Related to import and export. So related to imports, when vessels or aircrafts come into India, those vessels or aircrafts should only land in customs port or airport only. However, in exceptional circumstances, they can land in other places. Correct? Only in exceptional circumstances, but that too they have to inform. Immediately they have to inform the customs. Else, it has to land in customs port or airport only, because customs stations will be there only in customs port and airports. It will not be there throughout the country. Therefore, so to ensure that there is no escaping of customs duty of the imported goods, they ensure that the vessels or airports should only land in that particular area. And as soon as it comes to the port or the airport, they have to file delivery of, they have to file the arrival manifest or import manifest, IGM, import general manifest. as well as passenger and crew arrival manifest. What is this passenger and crew arrival manifest? There are two things here. In relation to passenger and crew arrival, before the arrival of the vessel or aircraft, you have to submit passenger and crew arrival manifest. The number, the details, etc. Specific details of who are the passengers, etc. will be given after arrival. Passenger names, record information will be given after arrival. So before arrival, you'll just give a manifest, the form that in a format prescribed, the number of people, etc. After it is arrived, the name records will be given after arrival into the station or the port. Clear? Yes. Once you submit the arrival manifest or IGM, right, you will be granted entry inward. Only after you are granted entry inward, you are allowed to unload the goods from the vessel or aircraft. Only upon granting entry inward, right? As well as and what would be there in IGM? Import general manifest or arrival manifest. You should mention the details of the goods, the list of the goods that is being brought in. So only those goods which are mentioned in IGM will be allowed to be unloaded. If that goods is not mentioned, it will not be allowed to be unloaded, and unloading or loading, as the case may be, should happen with the supervision of the customs officer only. We ourselves, suo moto, cannot do it, and it should be unloaded or loaded only at approved places. There would be some designated place in the station for loading and unloading. It should happen only in that case. Now, especially in case of customs port, can we take the goods to the water? Can the goods be waterborne? Either at the time of unloading or at the time of loading for export. It says normally no. Right? It should be loaded or unloaded only in the customs station. However, in some exceptional circumstances where it's not possible to load or unload in the customs station, where we have to take it a little further and then load it in the vessel, you can take it in a boat using boat note. Right? Boat note has to be submitted and approved. Only with that you can do it. Now, once the goods are unloaded, till it is clear for home consumption, it's the responsibility of the custodian. Right? Custodian, that is the commissioner or the officer who is in charge of that customs port. So custodian's responsibility of such goods. So that is the reason we have those remissions or no duties on pilferage and complete destruction, destroyed or lost, etc. Correct? Yes. And bill of entry has to be submitted, filed, presented. When will the bill of entry be presented? There are three types of bill of entries. First one, form number 1, which is in white. This is for home consumption directly. I have imported, it was brought into the country, directly I'll take it out for home consumption. Second one, form number 2, which is in yellow. This is for warehousing. So I'll not clear it now. I'll keep it in the warehouse. So that is for warehousing. And third one, form number 3, which is green. What is green form used for? It is in the warehouse. So home consumption from warehouse. For that, bill of entry will be form 3. So if I'm directly taking for home consumption, only one form to be filed. If I'm taking to warehouse and then clearing for home consumption, at the time of taking to warehouse, form 2, from warehouse to home consumption, form 3. Right? That's how the bill of entries are filed. And bill of entries have to be filed. These are what you say, the soft copies. It's online, right? Automated process in the IceGate portal. Yes. Then, however, bill of entry is not required for transit and transshipment. Bill of entry is not required for transit and transshipment. What is this transit and transshipment? Anyone? Transit, transshipment.
IGC.
No, not high sea sales. Transit means, let's say that vessel is coming from South Africa. It is coming from South Africa. Let's say it came to Cochin. From Cochin, it is there here. Now, there are certain goods that will be imported into that will be unloaded there in the Cochin port. But there are some goods which are not for Indian consumption. It has to go to other ports, right? Let's say it should go to Australia. So in that case, the vessel has come into India. It has entered the territorial waters, meaning it should be import. Correct, import. But these goods are not meant for Indian consumption. So those are called transit goods. So on transit goods, no duty is payable. Therefore, no bill of entry required. So whatever is unloaded, for that you file the IGM, for that you file the bill of entry, and balance whatever is there, you take that along with that vessel, you take those goods. That is transit. In some cases, what happens? Yes, from South Africa, it came to India. That vessel will not go forward, will not go further. So certain goods in that vessel should go to Australia. What they have to do? There is one more vessel. So from this vessel, they'll shift the goods to that other vessel in the Indian port. And then this vessel will take it outside the country. That is called transshipment. That is called transshipment. In both the cases, no bill of entry required, no duty will be payable. Because that customs station, in the customs station, the goods are not unloaded, nor it is intended for home consumption. Yes. What's the time limit for filing bill of entry? For filing bill of entry, especially in case of this form 1 and form 2, will be the end of the previous day, preceding day on which vessel arrives. Before the end of previous day. So if a vessel arrives on 26th of March, before working hours of 25th, you should have filed the bill of entry. You should have filed the bill of entry. Either form 1 or form 2. If you are taking for home consumption, form 1, else form 2. Yes. Next one. Assessment of goods. Section 17 talks about it. Now, first duty will be self-assessed. By whom? By the importer or the exporter. Based on the self-assessment made, that will be verified by the proper officer. Verification by proper officer. If the proper officer feels that self-assessment is not done properly, then he will do reassessment. Reassessment by the officer if self-assessment not done properly. Based on the reassessment done, speaking order will be passed. See, if the self-assessed is verified and verified by the proper officer and found correct, the process ends here. Only if it is not correct, then he'll do reassessment and a speaking order will be passed with reasoning why it was not correct and why the assessment made by him is correct. So that order has to be passed. Yes, in some cases, similar to GST, provisional assessment is possible. Provisional assessment, where importer is unable to make the assessment, he can apply for provisional assessment. When an application is made, the officers who part of that provisional assessment will ask for certain documentation, details. Within 15 days, you have to furnish that details. And upon filing the application, upon receipt of these details, the officers have to conclude the assessment within 2 months. Within 2 months, the application, the provisional assessment application have to be disposed of. Clear? Similar to GST. See, these provisions are similar. Okay, so easy to compare and discuss. Similar to GST, we also have customs audit here. Okay, in GST audit, here we have customs audit. Now, in case of customs audit, there are 2 types. In GST audit also, we have 2 types. One is 65 and second one 66. Here, what are the 2 types? One is TBA, one is PBA. What is TBA? TBA is transaction based audit. So this is transaction specific. Wherever the officer has doubt on a particular transaction, he will do that audit. Now, audit is done when? Time of clearance or later?
Later.
Later. Yes, audit is always what do you say? It's a post-mortem, right? So it has to be done subsequently. Subsequently, if the officers feel that no, that particular transaction there is suspicion, on that transaction they can do audit. Second one, what is PBA? Premised based audit. So they can come to the premise of the importer or the exporter, as the case may be, and do the audit there. In sometimes TBA has so many irregularities so that it might lead to a PBA. Okay, so in transaction based audit, if they find irregularities, they might convert it into a premise based audit. Yes, these are the two types of audits under customs. Then next one that we have is clearance of goods. In case of clearance, duty has to be paid, right? However, for certain categories of people, deferment of payment of duty is allowed. So, meaning they will be allowed to clear the goods without payment of duty. Duty can be paid later. Who are those? There are two categories notified. One, importers registered or certified under authorized economic operator tier 2, tier 3. Who are these authorized economic operators? These are people who are notified under FTP, Foreign Trade Policy 2023. So they have there we have the concept of AEO, authorized economic operators. When we discuss about FTP, we'll just look into it. So those importers who are certified as tier 2, tier 3 under AEO, then for them this deferred payment of tax is allowed. Apart from that, authorized public undertakings, PSUs, they also are allowed for making deferred payment. When I say deferred payment, what is this deferred payment? Till what time? For all the imports that they have done from 1st to 15th of a particular month, you pay consolidated customs duty on 16th. Allowed. For all the imports done on from 16th to end of the month, except March. Except March, you can pay 1st of the next month. For imports done from 16th to 31st of March, you have to pay on 31st of March itself, end of the financial year. So close it, don't take it to the next financial year. End of the financial year itself, 31st March. Clear with this deferred payment? Yes. All the assessments that happens under customs are now faceless. Faceless assessments through IceGate portal. Now, payments also, most of the cases, payments happen through electronic cash ledger. Concept of electronic cash ledger is there in customs services. Same concept as we have in GST, right? Electronic cash ledger to pay duty, interest, penalty, etc. However, wherever in those custom stations where automation is not there yet, where automation not in place, in those cases, payment through ECL is not mandatory. You can pay manually. Similarly, in relation to accompanied baggages, payment through electronic cash ledger is not mandatory. In all other cases, payment shall happen through electronic cash ledger only. Similar to electronic cash ledger, in GST we have two: electronic cash ledger, electronic credit ledger. Here also we have electronic cash ledger, electronic ledger for duty credit. Electronic ledger for duty credit. This is all financial benefits in the form of duty drawback, in the form of remissions, right? In the duties, all those benefits will be credited to this ledger, which you can utilize for further payments, right? Benefits will be credited here. So they have brought in a uniform compliance, right? So everything, all benefits that you get under customs law will be credited to duty credits. Whatever tax you pay will go to electronic cash ledger. Right. So electronic cash ledger can be used for payment of tax, interest, penalty, but duty credit ledger only for payment of tax. Same, whatever concept that we have in GST. This is about the payments aspects. Are we understanding? Yes. Then next part of our discussion is exportation. Exports. Section 39 says export of goods will not be allowed unless entry outward is granted. Similar to import. In import, unloading is not allowed unless entry inward is granted. Here, entry outward permission. Entry outward is granted. To get entry outward, what should be given? So in that goods to be accompanied by, if the export is happening through seaport or airport, you will give shipping bill. If export is happening through land custom station, those countries where we share land borders, right? Land custom station, in that case, bill of export. In case of transshipment, bill of transshipment. See, that's the thing. In case of transshipment, for goods coming into India, no bill of entry required. But for transferring the goods from one vessel to another, for unloading in the second vessel, bill of transshipment is required. For unloading into the second vessel, bill of transshipment is required, because once it is unloaded to the second vessel, it is going out of India export. Correct? So, bill of transshipment will be required. Yes. Then we also require EGM, Export General Manifest, or Departure Manifest, as well as Passenger and Crew Manifest. Same, whatever in import we have, same in relation to export as well. Unless there is a return order by the proper officer, that vessel conveyance cannot leave. That return order is compulsory. This is the provisions in relation to export. Then next important discussion that we have in customs. Till here clear, right? Everyone? Yes. Yeah. Next concept, important one that we have is baggage. In relation to baggage, every person, right, has to, owner of that baggage has to file baggage declaration form. What will be there in baggage declaration form? The details, the list of the items that is there in that baggage. Baggage declaration form has to be filed. And on baggage, you have to pay duty. Correct? So the rate of duty applicable for baggage is 35% ad valorem. 35% on the value addition, ad valorem. However, in some cases, you are allowed to bring in the baggage duty-free. Duty-free baggage allowance. If this is not met, then you have to pay the tax. If you are under this duty-free baggage allowance rules, then you can import without paying any, you can bring it into India without payment of any duty. What is this duty-free baggage allowance? If you are an Indian resident of India, or a foreigner residing in India, or tourist of Indian origin. Tourist of Indian origin coming into India, excluding infant. Coming into India from any country other than Nepal, Bhutan, and Myanmar. Right? Other than this country, coming into India from any country, per person, you are allowed to bring your personal effects, used personal effects, right? Your luggage, used personal effects, travel souvenirs, along with that, articles worth rupees 50,000. So you would have, when you go out of India, obviously you will purchase some things outside India, right? To give for your use or to give as gifts to someone else, chocolates, memorables there, right? So whatever you will purchase. So articles up to 50,000, no duty. Freely you can bring into India. This is for residents or foreign residing in India, etc. Foreigner residing in India, tourist of Indian origin. If you are a tourist of foreign origin, other than Nepal, Bhutan, Myanmar, same condition. Personal effects you can bring in, no problem. However, for articles, only 15,000 rupees you can bring, not 50,000. Tourist of foreign origin, 15,000 rupees. Articles worth 15,000 rupees. However, if you are coming by land, only personal effects, no articles. Only personal effects can be brought in if you are coming by land. Clear? Yes, this is for the luggage or articles that you bring in. Now, if you are bringing jewelry, the condition is you should have resided outside India for more than 1 year. It's not, am I audible?
Yes.
Yes. It's not that you will go outside India, purchase jewelry, come into India. No, you should have resided abroad for more than 1 year. More than 1 year. In that case, for gents and ladies, there are separate limits. For whom it will be more?
Both ladies, sir.
Of course, yes. So for ladies, it would be up to 40 grams or value of rupees 1 lakh. Right? Value, when I say not Indian, not as per Indian, we have purchase value outside India, right? Of rupees 1 lakh. Gents, half of it. 20 grams, value of rupees 50,000. More than enough. Next, that's jewelry allowance. Then, in case of transfer of residence from USA, from New York, you want to shift, relocate to Bangalore, transfer of residence. In that case, obviously, all the household items you have to bring in. Correct? In that case, transfer of residence, they have given certain conditions, exemptions given. If certain conditions are satisfied. What are those? We'll look into the material. There, it's given in depth, in detail. For transfer of residence, a person who is engaged in a profession abroad or is transferring his residence to India will be allowed duty-free clearance of articles on his return in the manner given in the appendix below. Right? This is in addition to general duty-free baggage allowance under Rule 3 or Rule 4. Whatever we have discussed duty-free baggage allowance till now, in addition to that, this is allowed. If you had stayed abroad for 3 to 6 months, below 3 months, no benefit under this. Minimum 3 months you should have stayed outside India. 3 to 6 months, personal and household articles, up to 60,000 rupees you can bring in as an Indian passenger. 6 to 1 year, up to 1 lakh rupees of household articles you can bring in. Up to 1 lakh. However, if you have stayed for 1 year to 2 years, then up to 2 lakhs you can bring in. Indian passenger should not have availed this concession in the last 3 years. Right? This concession should not have been availed. For this, there is no condition. 60,000 and 1 lakh, there is no condition. For 2 lakhs, if you have stayed more than 1 year up to 2 years, then that condition of 3 years comes into picture. If you have stayed 2 years or more beyond, you can bring household articles worth 5 lakh rupees into India. Minimum stay of 2 years abroad immediately preceding the date of arrival is required. However, shortfall of up to 2 months can be condoned by the officers. 2 months. So 1 year, 8 months. Even though 1 year, 10 months rather. 1 year, 10 months, even though falls under this, there is a difference of 3 lakhs. If he stays 2 more months outside India, he'll get benefit of 3 more lakhs. So that 2 months shortfall can be condoned by the officers. Okay, if the early return is on account of terminal leave or vacation being availed of by the passenger, any other circumstance for reasons to be recorded in writing. Because of that, if there is a shortfall, yes. Total stay in India on short visit during the 2 preceding years should not exceed 6 months for this case. Right, for this case, second condition, you should have stayed 2 years abroad minimum. And in the last 2 years, when you have come to India for a temporary visit to attend functions of family members, etc., the temporary visits in aggregate cannot exceed 6 months. Right? Cannot exceed 6 months. If there is in excess of 6 months, yes, commissioner, if it is valid, they can condone that also. And passenger has not availed this concession in the preceding 3 financial years, preceding 3 years. In that case, household articles to this extent can be brought in. Are we clear? Yes. Then unaccompanied baggage. So your baggage didn't come along with you. Your baggage came later. Can it happen? The answer is yes. Right? There are various circumstances wherein it can happen. However, baggage should come in. Unaccompanied baggage should come in within 2 months. 2 months from the arrival of the passenger. However, in exceptional cases, it can be extended up to 1 year. Freely, with duty free. Freely it can be brought in. Yes. Unaccompanied baggage of passengers. Crew members of the port, airports, so pilots, air hostess. So in relation to them, crew members, crew baggage. This baggage rules, normal baggage rules that we have discussed, that will apply to them upon termination of their employment. Last day of their employment, when they're bringing everything back to India, right, from their place of work. So for them, baggage rules will apply. Normally, when they're traveling from as part of their profession, when they're traveling in the airports, ports, etc., if they are coming into India, they can bring articles up to 1,500 rupees per visit. So they'll obviously be, when they're traveling, their family members will be asking, you bring chocolates next time, you bring that article next time, correct? So up to 1,500 per visit, they're allowed to bring it for crew members. Yes, this is about baggage rules. Next, we discussed that when goods are imported into India, it need not always be taken out of the customs port. We can keep it in warehouse before clearance for home consumption. In case of warehouses, there are 3 types of warehouses. One, public warehouse. Second, private warehouse. And third, special warehouse. This public and private warehouses are not under physical control of customs authorities. They will not have the key of it. Physical control of customs authority. These are licensed based. If you want to open a warehouse in the customs port, you have to take a license, right? And you can operate. You can operate the warehouse. Importers can come to your warehouse and keep those goods and pay rent to you. That can be done. But it is based on license. You have to take license. So not under physical control of the customs authorities. They will not have the key. You, being the licensee, will have the key. So public and private warehouses are record-based controls. The controls are record-based. What is the difference between public and private? In case of a public warehouse, any importer can use it. So you have opened a warehouse, any importer can come and keep the goods in your warehouse upon payment. Whereas private warehouse is exclusively for you as a license holder. You will not allow anyone else, right? Only to keep your goods. So if you're importing frequently large amount of quantities, and most of the time if you're keeping in warehouse, instead of using a public warehouse, you can take your own warehouse, correct? A private warehouse, yes. So this is only for the licensee. Whereas a special warehouse, this will be under customs lock. So this will be under the customs lock. Customs authorities physical control. Lock will be with them. Key will be with them. So what will be kept here? there are certain notified goods which will be stored in this special warehouse. Notified goods which will be stored here. Clear? Yes. Then next one. License, once you get the license to open these warehouses, that will be forever. Okay, then there is no concept of renewal, etc. However, that license can be cancelled. Again, it can be suo motu cancellation or cancellation by the licensee themselves. They can apply for cancellation. If I do not want the warehouse going forward, I can cancel it. Correct? So it can be cancelled. Once it is cancelled, we cannot throw off all the goods which is there inside at once. So you will be given 7 days time. Within 7 days, you have to remove all the goods inside that warehouse. Now, when you keep the goods in the warehouse, there should be a warehousing bond. That is the reason it is called in bond. Right? In GST also, we discussed this in Schedule 3. When goods are in the warehoused goods are sold, it's called in bond sale. Why? Because the goods are in bond. What is this in bond? When the goods are brought into India and you're keeping it in the warehouse, yes, without payment of duty, you're allowed to keep it in the warehouse. Correct? Without payment of duty. So that since they are given that benefit of deferring the payment of duty upon clearance for home consumption, you have to give a security. You have to give a guarantee, a bond stating that subsequently I'll pay the duty. Right? So that bond has to be given. Right? An indemnity bond has to be executed. Indemnity bond. That indemnity bond can be a consignment bond or it can be a general bond. So if you are imported only once, if you are a not frequent importer, then you can give a consignment bond only for that import, only for that goods, only for that consignment. Or if you are a frequent importer, frequently you are keeping it in warehouse, you can have a general bond. Right? So and so up to so and so amount, I can keep it in the warehouse. So that track, even customs authorities will have that you have out of the total limit, you have exhausted so and so, only balance is remaining. So if you are exceeding that limit, you have to give a fresh bond, fresh indemnity bond, right? So that will be taken care. So that is under general bond. When I keep it in the warehouse, till what time I can keep it in the warehouse? There are two circumstances. If manufacturing or other processing is allowed in the warehouse, in some cases, manufacturing or other processing is allowed in the warehouse itself. In that case, till they are removed, right? Till the manufacturing is complete, till they are removed, X bonding is done, you can keep it in the warehouse. In other cases, you can keep it in the warehouse up to 1 year from the order permitting the removal. So once it is kept in the warehouse for removal, you have to take a approval of it, permission. So once you get the permission for removal, 1 year you can keep it. Within 1 year, you have to take it out. In case of EOUs, EHTP, STP, etc., till they are removed, you can keep it in that warehouses till X bonding. Now, when I say removing from the warehouse, when I remove from the warehouse, what will we do? For what purposes we will be removing from the warehouse?
For home consumption.
Home consumption is one such purpose. There are 3 purposes for which it can be removed. Okay, removal from the warehouse. Sale in the sense if you are selling in India, it has to get cleared for home consumption. Right? See, inside inbound sale means there is no removal from the warehouse. Just the title gets passed on. Correct? So if you are removing goods from the warehouse, one is for home consumption. Perfect. Second, that warehouse is becoming costly. You are shifting it to another warehouse. Transfer from one warehouse to another. Third, exporting without bringing it to home consumption, clearing for export directly from the warehouse itself, we'll export it. clearing for export. These are the three purposes for which it can be removed. However, you have to take permissions in all the three circumstances. Yes, this is about warehousing. The last concept in customs is refund. Refund of the duties. Now, there are multiple ways for which refund, multiple purposes or circumstances where refund will be applied. First one, if you have paid excess duty or excess interest amount, then you can apply for refund. Right? Who can apply for refund? Who has borne the incidence of the tax. Same concept in GST, whatever we have done, doctrine of unjust enrichment. Same concept applies here also. Who has borne the incidence of such duty will have to apply for the refund. Time limit is within 1 year from the date of such excess payment. 1 year from the date of payment, you have to apply for the refund. So the time limit is lesser here, unlike GST. Once the application is filed, in GST they have 60 days. Here the officers have 3 months to process the application. If they do not process the application within that time, for delay, they have to pay interest. Here, interest rate is not fixed. It is discretion of the officer, 5 to 30%. That's the range that they have given. So at the discretion, depending on the circumstances, they can fix the interest, 5 to 30%. Then, in second scenario, refund of the export duty that you have paid. At the time of export on certain goods, export duty will be applicable. That export duty paid can be refunded in the following circumstances. When the goods that you have sent abroad came back, when goods are returned, sales returns, as if export didn't happen, correct? So when goods are returned, when goods are re-imported within 1 year, for whatever reason, it could be you could have sent it for repairs, etc. Within 1 year, it is re-imported. And application for refund should be made in those cases. Application for refund should be made within 6 months from the clearance for home consumption. Those goods which are brought into India, clearance for home consumption, within 6 months, you have to file the refund for home, refund of the export duty paid. Similarly, refund of import duty. Refund of import duty. In relation to refund of import duty, when can the import duty be refunded? When you are sending the goods back because the goods are defective. If the goods are defective and you have not claimed any drawback, no drawback claimed, and you are applying making an application within 6 months. So cumulative conditions, right? Both the cases, cumulative conditions. Goods are returned within 1 year, application for refund within 6 months. Goods are defective, no drawback claimed, application filed within 6 months. In these cases, refund will be given. However, no refund in case of perishable goods. For perishable goods, there is no refund allowed. Any doubts in this? No. Fine. So this is about the customs part of the discussion. Okay, Customs Act is done. Customs Act discussion is completed. We are left with FTP, Foreign Trade Policy. Now, we all know foreign trade policy, recent one, 2023 is notified last year from 1st of April 2023. Right? What is the, we'll just look into the salient features. I don't think so we'll be able to look into other parts, other aspects we can discuss in the next class. We'll just look into the salient features of this FTP, this new FTP 2023. Export imports of goods is generally free unless specifically regulated by the provisions of the policy. Now, can I export a particular goods? Can I import a particular goods? Yes, normally it is free. However, in some cases, for some goods, they will regulate. They will prohibit export of certain items. Whenever prices of the commodities increase, they'll prohibit export of onions. Correct? So that it will be through these FTPs. So unless it is regulated by the provisions of the policy or any other law for the time being in force, export and import are broadly classified as free, restricted, prohibited. Some goods are free for import and export, but can be imported and exported only through state trading enterprises. Not everyone, not private import and export, only through state trading enterprises. There are restrictions on export and imports for various strategic, health, defense, environment, and other reasons. If goods are restricted for import and export, what do we understand by restriction? You have to take permission. Right? Free means without anyone's permission you can bring. Restriction means you have to obtain permission. Prohibition means not at all possible. Right? If goods are restricted for import or export, but not prohibited, government can give a permission or license for specific reason. Exports are promoted through various promotional schemes. We will discuss about those schemes: duty remission schemes, duty exemption schemes, duty drawback, EPCG schemes, correct? DFIA, advance authorization. There are various export promotional schemes. Goods and services to be exported, but not the taxes. Hence, any indirect taxes on exports are either exempted or refunded on both imports and outputs and inputs through application of various schemes in the form of duty exemption or duty refund, drawbacks and rebates, as the case may be. Capital goods can be imported at nil duty for the purpose of exports under EPCG. So if you're an exporter, you want to purchase machinery for manufacturing of export goods. So if you have to import it, you can import it at nil duty. If you come under EPCG scheme, export promotion capital goods scheme. For units undertaking to export all their productions, there are special schemes so that they can avoid taxes at every stage. EOUs, SEZ. So the condition there is 100% you have to export. Right? They'll be given benefits, various benefits. In certain specified cases, imports gets duty exemption, concession, remission for certain special purposes. In such cases, to enable domestic suppliers to compete with the international suppliers, supplies of domestic suppliers are treated as deemed exports. Same concept. Right? The supplies to EOUs, that is advance authorization, they come under the deemed export provisions. What happens in case of deemed exports, we can discuss later. Okay, these are the features of FTP. What is there in this particular foreign trade policy of 2013? Introduction of it. So there are various discussions. So we have a concept called status holder. For them, there are various privileges that they get, right? Different stars that they have. And we have a concept of, we have export promotional schemes, different types of export promotional schemes to be discussed. All these we can discuss in the next class. Everyone understood, followed whatever we discussed today?
Yes.
Yes. Completely, and it was good. It was we were able to follow. Yeah, fine then. Okay, fine. We'll have to discuss about FTP and then we'll move on with other discussions in the next class. Okay, thank you.
Thank you.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.
Bye.